How to file taxes for a startup business. This is so critical because so many of you, you're living in what I call your old W-2 world and using your CPA as a historian. So you hand them all your stuff at the end of the year, hope to gosh they can get some strategy out of it. Most of them can't because you have to play along with a lot better discipline and responsibility and accountability to what they're going to need. So in our world, we do it very different. We live what we call corporate life. So to file taxes for a startup, we're going to talk about, number one, what most startups do wrong. Number two, why filing is not the same as strategy. They're very different experiences and different behaviors. And the last thing, what to do early to protect your cash flow. And most entrepreneurs, it's surprising, don't have enough financial literacy to even understand cash flow or manage it with a lot of strategy. So you actually are keeping more of everything you make every time you pay a bill, every time you pay taxes. So first, let's start with some fun facts from the IRS, right? So again, this is a very American-centric video. In your country, you will have very similar rules, if not even stricter. We teach, obviously, that tax is the biggest expense most of you will ever pay in your lifetime consistently. So filing, again, we'll get to that, is different than strategy, and we do strategy. Other things just to note, the IRS rewards planning, not ignorance, because you just didn't know. The code is visible. You can go look at it on the internet machine and see that it's out there and you can follow it. I don't think your CPAs, even though they're interesting for you, they probably aren't following all of the code. The entire IRS tax code is over 80,000 pages. We had the big, beautiful bill that came into effect July 4th of 2025 that allows for a lot more variation and deductions. Your entity choice is vital. So the difference between an LLC, an S Corp, a C Corp, and a limited partnership is nothing that you should ever be deciding. So that's why I don't really like just you going to the Secretary of State or LegalZoom or any of these online portals where a low cost, you can get your EIN and your number, but you're not getting everything you need. You're not getting your binder. You're not getting your corporate minutes. You're not getting your operating agreements. You're not getting your shareholder, your resolution, articles of incorporation, your seal, your stock certificates. You typically aren't getting all of that with those online portals. So how you pick your entity is critical to then what will be your tax return at the end of the year. Or if it's a C Corp, it files completely separate, doesn't even have anything to do with you. So let's start with why and what people file wrong as a small business startup. So again, you treat your CPA like they're a strategist. Typically, you're handing them things around March or April, and all they're doing is filing your return and signing their license number. So by doing that, typically they're going to be more conservative than aggressive and strategic, meaning forecast forward, look out into the future. What are you going to make this year? And don't make the assumption you're going to make the same amount every year. Unless you're an employee, then you will. But if you are an entrepreneur, you should be growing at 10, 15, 20% a year on an ongoing basis, or at least some version of that. When you're truly living corporate life, your company files taxes, which allows you to file tax at the end of the year in Q3 and 4. So for example, your company files tax September 15th, will pass through, your pass-throughs come to you, and you file October 15th. And you never want to have your personal or your business finances commingled. That's one of the first startup mistakes that we see a lot of you make. The other startup mistake in filing taxes is you stay a sole proprietor too long because someone told you that you don't make enough money to have a company. That's not true. It's not about income, it's your intention. And do you have the intent to truly live corporate life? Move these personal expenses like this, your phone, over to a business deduction. Move your vehicle to the degree you can from a personal expense to a business deduction, and you just keep going. We call it financially forecasting, and we forecast forward. So again, filing is just the filing and submission of the documents to the IRS. Strategy is looking at your whole life. It's looking at how you make money, which company's making the money. Do you need a second or third company to actually level out your tax burden and your asset and protection of what you have? Strategy is completely different. So we call it, again, forecasting forward. We're looking at what you're going to make quarter by quarter by quarter. We're looking at not only how you make it, all the deductions that you can put against that income, including officer and director benefits, including the Augusta rule, include research and development credits. There are so many things that a lot of CPAs just kind of leave behind. And you want to look at how you can invest, because investing alternatively does impact, because of the depreciation schedules, your tax return. So ours is looking at the holistic part of your life. How do you make it? How do you keep it? How do you invest it? All of that will add up to a great tax strategy. Most of you, Just look at April 15th as the dreadful year or worse. I know by your language and your behavior, if you're looking forward to your return, you overpaid. An interest-free loan to the government, and then you're getting your money back. You shouldn't have paid in the first place. And so when it comes to quarterly filings, that's really up to your tax strategist, your CPA, whether you need to be doing them, whether you do them once a year, whether you actually do them on a quarterly basis, but it adds up at the end of the year. So I usually do my filings in September, and then I personally file in October and pay then if necessary. Before we finish this video, subscribe to my channel, click that notification button so whatever device you're listening on, it gives you a notification. You're going to open it up and you're going to listen to the entire video. Even if you think you know what I'm going to talk about, I usually spin it a little differently. We just don't regurgitate videos. We actually repurpose and we redo them at all times. They're always fresh and new. If there's a topic that you want, put it in the comment section. And if you would, please, want to learn how to live corporate life, grab the 2 tickets that are in the show notes to my Millionaire Intensive. In the Millionaire Intensive, we teach you how to live corporate life, why it's so vital that you live this way if you truly want to oversee and guide your finances. It's not difficult. It's different than you've ever been taught. And it's a different way to manage debt versus be in a debt elimination program. You're in a management program. And we forecast forward. It's very different. Look forward to having you there. And I also want you to take advantage of my Millionaire Maker book. I gave you the entire download of version 2. Read up to chapter 3. Do your gap analysis. Where are you? What do you want? And then we'll have a conversation one-on-one with how our team can support you in what you need, where your gaps are financially in business and in wealth building. To make sure that you're protecting your cash flow early, you want to always make sure, again, you're not commingled. You have your personal finances, you have your business finances, you're paying the bills out of the right accounts, not just doing expense reports back and forth and being sloppy. Another way to manage cash flow is to do it, I would say, on a daily minimum of a weekly basis. You want to make sure you know where your money is. So the money in and money out, the more money in and money out of the financial services system gives you actually better credit and allows you to have corporate credit, allows you to get corporate credit in your cards. So make sure if you have a business, it's not in your Social Security number. Your Social Security number should be secondary to your EIN and your tax identification number. Should not be the primary, or you might as well have just stayed a sole proprietor. Choosing the right entity is how I'm going to wrap this up. It's vital. It is not your job to choose. It is our tax strategist's job to choose which entity is appropriate for your tax strategy, whether you need an LLC, an S Corp, a C Corp, how those are taxed. And some of you might need a partnership. All of those will be held in trust for legacy and asset protection. So if you have any questions during any of this, go to askloral.com, ASKLORAL, ask a question, make a request. We'll be back tomorrow.